many business owners, their biggest stress is, of course, tax, or more specifically, feeling completely in the dark about what they're going to owe. Even the most prepared business owners often come to us absolutely devastated because they've been saving for their tax bill all throughout the year, only to find the number on the return is way higher than expected. If either of those things resonate with you, please let's reassure you. It's not that you're doing a bad job. It is not that you've done the maths all wrong, and it is not that you can't afford to run your business. It's just that there is a bit more involved in predicting what tax you will owe than simply setting aside 20%. And the worst thing is, the information that tells you that is not readily available. And if it is, it's often not in plain and simple English. So here is that plain, simple guide to help you get a real good grasp on what you're going to owe on your tax return so that you can feel prepared when that time comes. So firstly, listen up if you're a sole trader. Here are the 5 things you need to take under consideration. Number 1, do you have paid employment somewhere else? If so, it's very likely that you're getting taxed on this already, or that it's already used up your tax-free personal allowance. So have a look at those pay slips, the information you've got from that job, and make a note of how much tax and national insurance you've already paid, deducted from your wages. Then the second step is to check if there is any of that tax-free allowance left. So for most people, it's £12,570 a year. So for example, you may have earned £10,000 in your employment. So you should therefore have the £2,570 available to be used as tax-free profits from your self-employment. But of course, you've probably already paid some tax through the employment. So it's good to have all of that information there. If your employment is above that tax-free personal allowance, then you'll basically be paying tax on all of your self-employed profits. Step 3, what are those self-employed profits? So this is all of your sales minus any allowable expenses. And of course, we've got tons of information in other blogs and videos about what those expenses are. Step 4, that profit number, 20% of it should be what you owe in tax. Now, as your profits increase, for example, when you go over 50,000, the tax rate increases as well. So do be aware of this, although if you are at that level, you really need to be operating as a limited company. Check out our articles to see why. And finally, will you be needing to make any national insurance contributions? We will discuss these rates later, but for now, just be aware, if you have paid national insurance through your employment, you're most likely all good. If not, you will have some contributions to make. Okay, are you a limited company director? Here are the steps that you need to follow. Number 1, are you employed by your limited company? Now, for most directors and most companies, taking the tax-free allowance as a salary is the best and most tax-effective way for you to get money out of the business and reduce your corporation tax. So most likely you're doing that. Then you'll need to look at what were your dividends. So how do you work out what dividends you can have? After corporation tax, whatever profits are left in your business are available for you to be taken as dividends, and these are taxed at only 8.75%. Here's a note, the dividends are usually declared at the end of your company's financial year, which may not be in line with the tax year. So, for example, your company year end might be the 31st of December, but the tax year ends on the 5th of April. So your dividends will be dated 31st of December and will be included in the tax year that ends on the following 5th of April. Yes, of course, these dates can all get a bit confusing, so just get yourself a good accountant who will deal with this for you. And then finally, it's putting it all together. What is your total income? So as we said, tax rates and personal allowance rates will change once you go into certain brackets, like earning more than 50 or 100,000. So if you are doing well enough to be up there, seek clarification on what changes this does mean to your tax. Okay, what other considerations are there? If you are completing your own tax return, you will see pages and pages of questions asking about all kinds of income, benefits, expenses, and the like that you might have had. Now, instead of getting bogged down in all of that, general rule of thumb, if you haven't heard of it, it probably doesn't apply to you. But some that do commonly apply to a lot of people would be property income, pension contributions or pension payments, student loans, child benefit, marriage allowance, other shares and dividends in other companies, and the like. If you're starting to get into a bit of a complex territory by adding a few of these into the mix, just do yourself a favour and outsource your tax return to national insurance contributions. Let's go back to that. If you're employed, you have most likely made national insurance contributions through your employment. And just as a note, national insurance contributions are not taken from your dividends. Although in many cases, there's always an option to make voluntary contributions to top yourself up. As a sole trader, it's most likely that this is going to apply to you. So the current national insurance rates as of 23-24 are in this blog, or if you're watching the video, they are in the comments below. So have a look at those, calculate your national insurance as well, because that's a major thing that people forget to do. And lastly, this might hurt, so I'm sorry about that. But if the tax that you owe from your self-assessment is more than £1,000, HMRC are going to ask you for 2 payments on account. Each of those will be 50% of the tax that you owed for that year, meaning that you will pay your tax bill, but also pay the same again in advance for the following year. So you would pay your £1,000 tax plus £500 payment on account on 31st of January, another £500 payment on account on the 31st of July, giving you £1,000 payment in advance for the next tax year. So as you can tell, the first time this happens, it will hurt, but it does even out a bit after that. But being prepared in advance, knowing when this is going to come for you, is just going to save you a lot of tears. So this is a quick rundown of everything you need to know when predicting what you're going to owe for tax. Now, obviously, there are so many nuances, and predicting to the penny is almost impossible. But knowing that what you've saved is in the right region of what you're going to need is going to be a major factor in helping you enjoy running your business and sleep well at night. But if you don't like the sound of doing all the maths yourself, then listen up. All of our clients receive in-depth tax estimations throughout the year, as well as annual tax planning meetings and regular business reviews, so that there are no nasty surprises and you can sleep easy knowing that your business is running as tax efficiently as possible. If that sounds good to you, you know where we are.